Hi guys, welcome to the third chapter of the introduction to Forex scalping. So we are going to see in this chapter how to select the best broker that suits you. So we are going to start with the definition of pips in Forex. A pip is the basic unit in the Forex market. Most currency pairs are quoted in 4 decimals. In pips, in pip is the last decimal except for USD GPY, which is the second decimal. Euro USD 1 pip is equivalent to a variation of 0.301 if the Euro USD goes from 1.3010 to 1.3011, variation of 1 pip upward. If GBP USD goes from 1.5000 to 1.4999, change of 1 pip downward. If the USD GPY goes from 140.10 to 140.50, change of 5 pips. The pip is 0.01 for the USD GPY. Definition of a point. Today's brokers offer 3 decimal quotation for GPY currency pairs and 5 decimal quotation for all other pairs, so the point is the last decimal. For example, if Euro USD goes from 1.30,110 to 1.30,150, change of 0.5 pip upward or 5 point upward. If USD GPY goes from 140.100 to 140.150, change of 5 pips or 50 points upward. Definition of a lot. A standard lot is the equivalent of 100,000 units of the base currency in a Forex trade. A standard lot is similar to trade size. It is one of the 3 commonly known lot sizes. The other 2 are mini lot and micro lot. In the world of finance, lot size refers to a measure of a quantity of increment of a particular asset or product, which is deemed suitable for buying and selling. Different types of products are commonly viable in different lot size. Historically, spot Forex has only been traded in particular lots of 1,000, 10,000 or 100,000 units. More recently, however, non-standard lot size are also available to Forex traders. Standard lot equal 100,000 units of the base currency. Mini lot, it's equivalent to 10,000 units of the base currency. Micro lot equal to 1,000 units of the base currency. How to choose your broker. The main important thing that affects trading result is the broker. You can get stopped from your trade even if you have a perfect trading strategy because of a large spread, even if you are profitable, but the major profit will go directly to your broker because of high commissions that your broker offers you. So you have to choose the best broker that suits your trading style to optimize your profits. What type of broker to choose? There are a lot of brokers in the financial market industry. In this article, we are going to see some of them and which is the best for scalping. In first point, we have dealing desk brokers. Forex brokers that operate through dealing desk brokers make money through spread and providing liquidity to their clients, also called market makers. Dealing desk brokers literally create a market for their client, meaning they often take the other side of a client trade. As we see in this illustration, we have here a trader. It places an trading order in the trading platform of a broker. The order goes directly to dealing desk. If the trade of the trader is winning, the broker loses money. If the trade of the trader is losing, the broker will earn money. So dealing desk brokers trading against the trader. So you have to be aware of dealing desk brokers. Non-dealing desk brokers. As the name suggests, non-dealing desk brokers do not pass their client orders through a dealing desk. This means that they do not take the other side of their client trade, as they simply link two parties together. Non-dealing desk brokers can either be STP or STP plus ECN. See this illustration: a trader that plus a trading order in the trading platform of the broker. The order goes straight to the interbank market, so it don't pass through dealing desk. It passes directly to the interbank market. So you're trading against other trader. You are not trading against your own broker. What is an STP broker? Some brokers claim that they are true ECN brokers, but in reality, they merely have a straight-through processing system. Forex brokers that have STP system route the orders of their client directly to their liquidity provider, who have access to the interbank market. Non-dealing desk STP brokers usually have many liquidity providers, with each provider quoting its own bid and ask price. Usually you will have large spread than ECN broker, which is not suitable for scalpers. What is an ECN broker? A true ECN Forex broker, on the other hand, allow the order of their client to interact with the orders of other participants in the ECN. Participants could be banks, retail traders, hedge funds, and even other brokers. In essence, participants trade against each other by offering their best bid and ask price. ECN also allow their client to see the depth of the market. Depth of market displays where the buy and sell orders of other market participants are. Because of the nature ECN, it's very difficult to slap on a fixed markup, so ECN brokers usually get compensated through a small commission. The broker that I personally use. Today, you can find a lot of true ECN brokers with a good regulation and best quality of their services, competitive commissions and perfect spread, all what a scalper need to be successful. I personally using Pepperstone broker for a long time. They offer a good ECN account with tiny spread and low commissions, but you can find a good broker that suits you. What I will advise you is to select a perfect broker with the aspects that we saw in this third chapter. You have to compare spread between brokers and see if it's an STP or it's a true ECN, dealing desk or non-dealing desk, to compare also commissions. So that's it for today's chapter. So see you soon. Hey guys, congratulations for making an amazing decision to enroll to our course. So let's start with the introduction to Forex scalping. So many traders are asking what is scalping. Scalping is a trading strategy in which traders profit of small price changes in Forex market. Generally, scalpers focus on short-term trades. As you can see in this chart, we have the chart of Euro USD. A trader will focus on catching like this trades 5 to 10 pips. Sometimes it goes to 20 pips. It's depending on the market conditions. So the trader will focus also on doing a multiple of trade in a sequence. What I will teach you in my course, I will teach you to catch a lower risk, high reward movement with large trading volume. This is my scalping strategies. It's not like other scalping strategies where traders will take up to 100 trades, but a lot of a percentage of 20 or 30 or maybe 50% of their trades are missing trades or lose trades. So in my scalping strategy, we will focus on catching low risk, high reward movement to scalp. So to be consistent in scalping, it's depending on many factors. We will see this in the next slide. Success keys of a scalper. These are 4 rules to achieve success in Forex scalping. So a trader need to have a good Forex brokers that offers you tight spread and low commissions. That's very important point. So we will develop that in next chapters. The second point, you need to select the best Forex currency pairs to scalp. You don't have to disturb yourself of searching to trade all currency pairs, so you have to specialize in certain currency pairs, which we will develop also in other chapters. Third point, you need to have a good internet connection, because scalping it's so fast, so you have you need to have good executions of your trades. Also, if you need to take your profits and exit your trade, it should be very quick. Okay. The fourth point, you need to have an emergency plan if anything wrong happens, like desktop goes down, electricity or internet connection issues. So you need to have like your platform installed on your smartphones, and you have internet data to exit your open trade if you have one of the below issues or other issues. So that's it for introduction. Thanks again for enrolling to our course. See you soon. Hello guys, welcome back to the second chapter of this first part. So we are going to see the best Forex currency pairs to scalp. So there are a lot of traders who want to trade all markets at any time, and that's wrong. To be a successful scalper, you have to choose your market. I mean your best currency pairs based on the criteria below. So the first criteria is the liquidity and volatility, because if you choose a currency pair that is not liquid or volatile, you will not have opportunities to scalp. So non-volatile and liquid market will not give you enough opportunities. A very volatile market requires greater rapidity and reliable connection and excellent commissions. The second part is spread and commissions. you need to select a broker that offers you tight spread and competitive price and competitive commissions. So that's important thing that scalper need to add to his knowledge, because that will impact his trading profits. So you need to have a plan to how to fix that, and how to do that in a perfect way. So you have to favor liquid and volatile currencies such as major pairs, also for its tight spread like Euro USD, GBP USD, USD GPY, or Euro GPY. I did a comparison of spread on the major currencies. As you can see here, GBP USD, the spread is 0.4 pips. The bid is the difference. The spread is the difference between bid and minus ask, because in Forex market we have two prices. We have the bid and the ask. This is the bid and this is the ask. Bid minus ask, you will find the spread. Okay, so I will erase that. And for the second currency we have Euro USD, which have a very tight spread, 0.1 pips. Also USD GPY 0.2 pips. We have here the GBP GPY, which have the biggest pips. It's not large enough, but 1 pips it's good for scalping, because GBP GPY it's a very volatile market, so it's very good for scalping. So 1 pips on GBP GPY it's not dangerous for your trading results. In this slide you have to take a look at the spread of the minor and exotic currencies, which I will advise you to be aware of those currencies on scalping, but on day trading or swing trading you can trade them. So take a look at the IUD odd CAD currency pair, have 1.2 pips, and here USD MXN, which have 27 pips. So it's very large for scalpers. As a scalper searching to catch movement from 5 to 10 pips or 20 pips, so if you have a spread of 27 pips, so you can open your trade and in few seconds you will get stopped. So that will impact your trading strategy and trading performance. That's the point that I want you guys to understand. And here we have a cross pair of CHF GPY at 150 ticks time frame. I'm doing this time frame for opening a position because it optimizes your entry. That's it. So as we can see here, the CHF GPY, it's not a very liquid market, and also there's the characteristics of CHF GPY, that it's very choppy. So as you can see, the market is doing nothing. It's ranging in the same place with a big tail. So in this market you cannot scalp it. You can scalp it, you can sometimes have a good opportunity to scalp it, but it's not very profitable. This market also, I advise you to not scalp this market. Look at this beauty. Here we have the the chart of GBP GPY at the same time frame. So here in the same day we have a lot of opportunities to scalp. We can see here a good entry to take 20 pips, I think, or 30 pips. We have a second entry here. We have the third and fourth entry. We have the fifth entry here, and the risk is very low. The risk is very low here in this configuration. So in my strategy, I will focus to show you how to catch like those configurations in the Forex market to be very profitable and to catch very low risk and high reward scalps. Okay, so there is a big difference between this currency pair and this currency pair. CHF GPY and GBP GPY. GBP GPY is a good currency pair to scalp. I will show you in the next chapters how to analyze the markets to get very amazing opportunities like this. The importance of specializing and scalping. The first point, if you are not specialized in certain amount of currency pairs, you will be in the danger of dispersing. A trader dispersed try to catch all the movements in different currency pairs, and the result losing a lot of money. So the second point, it's imperative to master your market. When you choose a certain amount of currency pairs, like me, I'm just analyzing 5 currency pairs. When you choose a certain amount of currency pairs, you will master those markets, so it's easy for you to understand those currency pairs when you trade or when you have to stay away on and wait. That's the point that I want you guys to understand also in how to choose the best currency pairs to trade. The third point, you need to be focused during the trading session, because scalping, it's very fast. It's not day trading or swing trading where you have a lot of time to think and to confirm configurations and confirm patterns. So in scalping, you have to be focused and not disturbed by your phone or WhatsApp or Facebook or I don't know what. I'm personally specialized on the below currency pairs because of their liquidity, volatility, and their tight spread. So the first currency pair, it's Euro USD, the second GBP USD, the third it's GBP GPY, the fourth is Euro GPY, and the USD GPY. Just for analyzing this pair, we will see that in next chapters. Thank you guys for watching the second chapter of this course. See you soon. Hello guys, here we are in the second part of this course, which is Forex Scalping Technical Analysis. Note, in this part we will see only the important technical analysis, indicators and patterns. Because in technical analysis we have a lot of candlestick patterns. I think there are 43 candlestick patterns and thousands of technical indicators. So we are going to study just what we need to apply this strategy that I will teach you in other chapters. So in first place, we are going to see support and resistance. Second chapter, we are going to see candlestick patterns and price action. And the third the third chapter, we are going to see technical indicators and moving averages. And the last part, we are going to see how I personally analyze the market for scalping. So let's start. Support and resistance. What is support and resistance? Support and resistance levels are horizontal price levels that typically connect price bar high to other price bar highs or lows to lows, forming horizontal level on a price chart. A support or resistance level is formed when a market's price action reverse and change direction, leaving behind a peak or a trough swing point in the market. Support and resistance levels can carve out trading ranges like we see in the chart below, and they also can be seen in trending markets and market retrace and leaves behind swing points. Price will often respect the support and resistance levels. In other words, they tend to contain price movement until, of course, price break through them. In the chart below, we see an example of support and resistance levels containing price within a trading range. A trading range is simply an area of price contained between parallel support and resistance levels. Like we see below, price oscillate between the support and resistance levels in a trading range. Note that in the chart below, price eventually broke up and out of the trading range, moving above the resistance level. Then when it came back down and tested the old resistance level, it then held price and acted as a support. So this is the illustration of support and resistance. The other primary way support and resistance levels are created in a market is from swing point in a trend. As a market trends, it retraces back on the trend, and this retracement leaves a swing point, which an uptrend looks like a peak and a downtrend looks like a trough. In an uptrend, the old peaks will tend to act as a support after price break up past them and then retrace back down to test them. So this is a chart. So as we can see, we have here a support level, this horizontal red line. This is a support and this is a resistance. So as you can see, the market respect this support and resistance level. It's often reacting when market touch these areas. As you can see here, the market broke up the support, and this supported the market up, then retrace, then goes up until reaching this resistance. The market react, the sellers enter here, and the market drop down until the previous support. Also the market react, goes up to the resistance until it's ranging here. It's ranging between the support and the resistance until here the market breaks up the previous resistance, and this resistance, after broken, it will become a support. This line will support the market to start trending up. We are going to see the same chart here to explain you candlestick patterns and price action patterns with this support and resistance for you guys to better understand the concept of support and resistance, combining with candlestick patterns, combining with price action to understand very well the market, what the market is doing. So in a downtrend, the opposite is true. The old trough will tend to act as a resistance after price breaks down through them and then retrace back up to test them. Here's an example of a market testing previous swing point support in a downtrend. Note that as the market comes back to test the old support, the level then behaves as new resistance and will very often hold price. It's wise to look for an entry point into a trend as it comes back and test this previous swing point. See pin bar sell signal in chart below, because it's at these levels that the trend is most likely to resume, creating a low risk high reward potential. So for position entry, we are going to develop that in another chapter to see how to optimize the entry. So in this example, we are just going to see how support and how the market react to the support and resistance. We have here a downtrend. We have here a swing point, become a support, then broken down to become a resistance. We have here another support, become a resistance, and like that. This is the way how the market is working. So that's it for today's chapter. So see you soon. Hello guys, I hope you are doing good. So we are going to see the second chapter of the second part of this course, which is candlestick patterns and price action. So in technical analysis, a candlestick pattern is a movement in price shown graphically on a candlestick chart that some believe can predict a particular market movement. The recognition of the pattern is subjective, and programs that are used for charting have to rely on predefined rules to match the pattern. There are 42 recognized patterns that can be split into simple and complex patterns. In this chapter, we'll see only the important and the most accurate patterns. In technical analysis, transition between rising and falling trends are often signaled by price patterns. By definition, a price pattern is a recognizable configuration of price movement that is identified using a series of trend lines and or curves. When a price pattern signals a change in trend direction, it is known as a reversal pattern. A continuation pattern occurs when the trend continues in its existing direction, following a brief pause. Technical analysts have long used price pattern to examine current movement and forecast future market movements. So in the first case, we are going to see candlestick patterns, then we have to pass to price actions. A doji is a name for a session in which the candlestick has an open and close that are virtually equal and are often components in patterns. Doji candlesticks look like a cross, inverted cross, or plus sign alone. Doji are neutral patterns that are also featured in a number of important patterns. A doji candlestick forms when open and close are virtually equal for the given time period and generally signals a reversal pattern for technical analysts. This is how the doji looks like. So the markets open here and the price rise up until here the high and falls down and close here to mark a very small body. The open price and the close price, it's not very important to be the same to qualify this candlestick as a doji. It can have a small body, and we will consider it as a doji. And the color of the body, it's not important if it's blue or red. So in this kind of candlestick, we just see the high and low. In forex trading, we tell in this a tail. well, we see in the tail and the body. In the second point, we are going to see hammer and hanging man. A hammer is a type of bullish reversal candlestick pattern made up of just one candle, as it has a long lower wick and a short body at the top of the candlestick with little or no upper wick. When you see the hammer form in a downtrend, this is a sign of a potential reversal in the market. A hanging man candlestick is the same as a hammer but forms in an uptrend, and it's sign of a potential market reversal. So we naming hammer if we find this candlestick in downtrend. For example, we have here a downtrend. At the bottom of a trend, we see this candlestick. We naming that candlestick as a hammer. It often signals a potential trend reversal, like this. The hanging man is the same candle, like this. Generally find a hanging man in an uptrend, in the top of an uptrend. The hammer and the hanging man are same candles, but we change them depending on the trend. If the trend is an uptrend and we found this candlestick at the top, so we're naming that a hanging man. If it's a downtrend, we're naming that a hammer. It's a sign of a potential market reversal. Okay. In the third point, we are going to see inverted hammer and shooting star. So the inverted hammer is a type of candlestick pattern found after a downtrend, and it is usually taken to be a trend reversal signal. The shooting star is the same candlestick as inverted hammer candlestick pattern, but found after an uptrend, and is usually taken to be a trend reversal. So the inverted hammer and the shooting star are the same candlestick pattern, like this. This is the candlestick, but we differ that with the trend. If the trend is a downtrend, so we're naming that as an inverted hammer. If the trend is an uptrend, we're naming that as a shooting star, and it usually signal trend reversal. So if we see that and the trend and the next candlestick goes to confirm this candlestick pattern, and generally the trend reverse. Next, we are going to see bullish engulfing and bearish engulfing. These two candlestick patterns are very important. You have to understand that also. I mean, all the candlestick patterns that we saw in this slide are the most important candlestick in technical analysis. So engulfing, bullish engulfing. The bullish engulfing pattern is a two candle reversal pattern. The second candle completely engulfs the real body of the first one without regards to the length of the tile shadows. The bullish engulfing pattern appear in a downtrend. So this is the bullish engulfing pattern. We have here a candlestick, and the next candlestick will engulf the entire body of the previous candlestick. This is what we call in a bullish engulfing, and it usually a signal of the trend reversal, and vice versa for a bearish engulfing pattern. The last candle will engulf the entire body of the previous candlestick with a bearish. This is a bearish candlestick. It is a sign of trend reversal. So we are going to see here price action. In technical analysis, transition between rising and falling trends are often signaled by price pattern. By definition, a price pattern is recognizable configuration of price movement that is identified using a series of trend lines and or curves. When a price pattern signals a change in trend direction, It is known as a reversal pattern. A continuation pattern occurs when the trend continues in its existing direction following a brief pause. Technical analysts have long used price patterns to examine current movements and forecast the future movements. So here in price action we have 2 points, the continuation patterns and the reversal patterns. So the continuation patterns are generally like here a flag or a triangle. So if we see if we can draw a triangle in a down in an uptrend or a flag, this is a continuation pattern. That means that the market will do a brief pause, then break up the flag or the triangle to continue his uptrend, and it's the same case for a downtrend. This is a triangle or a rectangle, or we name in a flag like this. If it's go like this, it's like a flag. So in the second point we are going to see the reversal price action patterns. So in reversal price action patterns there are a lot of patterns, but what we are going to study is just the double top and the double bottom. So a reversal pattern is a transitional phase that marks the turning point between a rising and a falling market. As we can see here, we have a downtrend, a bottom, this is the top, and the market will draw another bottom. He will try to break down this previous bottom, and he cannot do that and reverse up. We can confirm that this is a true double bottom after breaking up the previous top and test the previous top. So we qualify this as a confirmed double bottom. It's the same case to double top. We have here an uptrend. The market will draw a bottom here, and the market will try to break up this last top, and he can't break it up, and the market will drop down and breaks down this previous bottom and test it. We confirm that this is a confirmed double top. So we will illustrate all what we study in this chart example. So as we can see, in the first place we have here a double top. A double top not confirmed. To mark a double top confirmed, it needs to break the last bottom, and here the market didn't break this last bottom. Okay, and also we have double bottom here, a double bottom confirmed. The market breaks the last top here, and also it's a resistance, and the market turns and the market pulls back to test the resistance and also the last top of this double bottom. And here it's a confirmed double bottom reversal. What we will remark also that the market always react in this resistance level and the support level. Here also we have a doji. We have here a bullish engulfing pattern, because this is a correction is ended by an bullish engulfing that signals the end of this correction. And here we have shooting star confirmed by a bearish engulfing pattern, And also here we have a lot of hammer, doji, and bullish engulfing also, as we can see here. Also shooting star confirmed with a bearish engulfing pattern. Here also we have a bullish engulfing pattern. Here we have an unconfirmed bearish engulfing pattern. These things that we see right now, it's the basic things of a forex market. So when you open up your trading platform, you will see in the daily basis all these aspects that we study in this chapter. You have to understand these concepts that we developed in this chapter, and try to do some exercises to practice this in real chart to master this technical analysis. So here we developed all what we need in technical analysis for scalping: support and resistance, price action, candlesticks. So we developed all technical analysis basics. This is the end of this chapter. I hope you guys understood very well this chapter, and see you soon. Hello guys, welcome to the third chapter in this second part. So we are going to see technical indicators. Technical indicators is a mathematical calculation based on historic price and volume. They are a fundamental part of technical analysis and are typically plotted as a chart pattern to try to predict the market trend. Indicators generally rely on price chart data to indicate where the price is going, or whether the price is in an overbought condition or an oversold condition. Technical indicators are chart analysis tools that can help traders better understand and act on price movement. There is a huge range of technical analysis tools available that analyze trends, provide price average, measure volatility, and more. So as I always telling in this course, we are just going to see what we need in to apply this trading strategy. So we are going, the first technical indicator that we are going to see is relative strength of index, RSI. The relative strength index, RSI, is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. Traditional interpretation and the usage of the RSI are that values of 50 or above indicate that the market is trending up. The value of 50 or below shows that the market is trending down. If the RSI value of 70 or above, it means that the market is overbought, and if the RSI is below 13, it indicates that the market is oversold. I personally use RSI with parameter 21 period close. So in the second place, we are going to see the second indicator, which is a stochastic oscillator. A stochastic oscillator is a momentum indicator comparing a particular closing price of a financial asset to a range of its price over a certain period of time. The sensitivity of the oscillator to market movement is reducible by adjusting the time period or by taking a moving average of the results. It is used to generate overbought and oversold trading signals, utilizing a 0 to 100 bounded range of values. I personally use stochastic with parameter 34 period, parameter K 5, parameter D 5, and simple. In the third place, we are going to see moving averages. In statistics, a moving average is calculation used to analyze data points by creating a series of averages of different subsets of the full data set. In finance, a moving average is a stock indicator that is commonly used in technical analysis. The reason for calculating the moving average of a stock is to help smooth out the price data by creating a constantly updated average price. I personally use two simple moving averages, one with 50 periods and the second with the 20 periods. So this is an illustration of my platform and how it's look like. In first place, we can see here the simple moving average 50 period with the blue color, and in the second simple moving average in the red color, which is the 20 moving average, simple always. And here we can see the stochastic with his parameter 34.55 and the RSI 21 periods. In the RSI, I'm using just the 50 horizontal line, but in the stochastic I'm using three, the 80 horizontal value, the 50 horizontal value line, and the 20 horizontal line also. So this is how my trading platform looks like. So this is for today's chapter. I hope you understand very good this part. So see you soon.